Welcome to the Nickels and Dimes Finding Financial Freedom podcast. I'm your host, Natalie Kime, and I look forward each and every week to bringing you amazing content that will provide you with a financial education, will support you on your financial journey, and most importantly, help you to find financial freedom. I hope you enjoy today's episode. I'm your host, Natalie Kime, and today I am discussing retiring well. I'm really focusing on the retirement side of finance, and I will still go over, basic financial concepts and things like that, because I think all of that builds to the idea of retiring well, having a plan in place, and the work that goes into building a foundation for that, and then stepping stones on top of that as well. But today I really want to talk about two specific products that I really use for my clients when focused on creating your retirement plan. I'm working with clients a lot of times that are younger, they're just getting started. And so there's a product I really use for that. And then those who are really in my target market, which is 10 to 15 years out from retirement or currently in retirement. And then, of course, for those who are assisting, supporting, caretaking for somebody that is in retirement and wanting to make sure that they do not outlive their money. So I want to get a little more detail on a couple of products for you. I don't know the last time I really talked in depth about any specific products. And, if you listened to last week's episode, you heard me interview my dad and just talk about some different retirement and things he felt like he did right and didn't do right. And in my social media, the last month or so, I share little videos, sometimes daily, sometimes 2 or 3 times a week, try to keep up with it, but of my dad giving advice to the people of the world. And it's just all kinds of different random things. And so last week's episode, I really wanted to have him on here giving maybe some advice and sharing some wisdom, things he's learned along the way when it came to his retirement. And things like that. So I hope you enjoyed that episode. But building on that, I really want to focus on these couple of products today. So the first one I'm going to talk about is we call it the financial pocket knife in my business. And the reason why is, if any of you have ever had a pocket knife or seen a pocket knife, you know that it's got a little mini saw, it's got a can opener, sometimes they have a toothpick, a corkscrew, little scissors, and then of course, the different size knives that all fold into this one device. So you can accomplish a lot with one little tool. And that is why we call this product the financial pocket knife. It's actually called the Index Universal Life Insurance. It is asset accumulation, protection, and embedded with tons of flexibility. So this is a product that I use for most often for somebody in their 20s or 30s. They still have a lot of years to retirement, and their budget or their availability to save might be smaller. It might be $100, $200 a month, just getting started. But because of the time they still have until they retire, that amount can go a really, really long way into growing something significant for their financial future. So the nice thing about the financial pocket knife, it has a flexible premium. So what do I mean by that? So financial pocket knife, let me go a little bit more in depth in here. It is a savings vehicle within a life insurance product. So you're getting that life protection of permanent life insurance. But within that, you have the ability to save. And that's where the flexible premium comes in. So you're going to have, a set premium you need to pay to cover the cost of your insurance. And then on top of that, anything you put in goes into the savings aspect and starts building wealth over time. utilizing compound interest, the time value of money, you can create something significant. And I'll walk you through an example of that on my son's policy here in a minute. So you're able to start out with, say if you're my son's age, he's 22 years old, start out with, $150 a month, cover your cost of insurance, and start accumulating some cash growth as well. But as time goes by, he makes more money. And so he wants to put more away. He has the ability to increase his payments and do what's called overfunding his policy. Now, there are limits on how high you can overfund your policy to stay within IRS tax requirements. And you'll hear a little bit more about the benefits from that tax side as we go forward. But so you have the ability to be flexible with your premiums. The other nice thing is I have some clients, I have one right now who was putting a significant amount. He's actually in his 40s, but he was in the financial position to really fund significantly his plan. And so it still made sense to use this tool for him. However, the end of last year, he was laid off from work. He had the ability to not only bring back down that overfunding amount, but drop his premium down to just the required amount for a few months while he looked for a new job. And now we're in the process of resetting that back up so that he can start accumulating cash again. So there's a lot of flexibility from the premium perspective in this product too. But let's jump a little more into the protection side. So again, I said you're going to get, that permanent life insurance up to age 121. It is a tax-free death benefit to your beneficiaries. It bypasses probate, and there's multiple settlement options, meaning you can take different kind of payments, lump sum, as you take that death benefit out. It also includes living benefits. So these products are amazing because I've talked before about the importance of having a long-term care policy attached somewhere in your financial plan. Now you can get standalone long-term care plans, but they are actually a lot less expensive when you attach them to a life insurance product. So living benefits attached to a life insurance product, instead of being an additional benefit amount you're paying for separately in its own policy again, it actually, what it's doing is giving you the benefit to tap into your life insurance while you're still alive, should you need to. So, what do I mean by that? It covers critical illness, chronic illness, long-term care, terminal illness. So, you receive a cancer diagnosis or you have a heart attack. You're unable to work for a period of time. You're unable to care for yourself, do the 6 daily activities that qualify for these benefits. These benefits can turn on. You can access your death benefit amount. So say you have $1 million, you can access that to help cover the cost of your care, help cover medical bills, help cover medications, all different kinds of things. So this is where this plan protects your life if you run into those kind of medical issues, run into those kind of diagnoses. So you're getting that permanent life insurance that's there if you die too soon, but you're also getting those living benefits to take care of you if you live too long. So you cover both of those things with this one product. Then if we switch over to the savings side, some of the phenomenal things included here are you earn interest. So based on a market index, but it gives you downside protection. You're never going to lose any of your money in this product. So even if the market's down, it has a 0 return year. In some of these products, you will earn the 0. And in some of them, depending on how they're built, you can still earn, like 0.75% or something like that on your money, which for me is bigger than I make in my savings account at the bank. So I'm still ahead of the game in a product like this. So you get that downside market protection, which means you're never, your balance is never going to be cut by 30% if the market drops or something like that. There's liquidity in this product. You have the ability to withdraw funds. You have the ability to take a loan against yourself for low and even after a period of time, 0 interest. So what does that mean? That means you have access to your money tax-free along the way. In addition to that, you are not required to pay back that money you pull out. Now, if you don't pay it back, obviously what's in there is not going to be able to grow to the same level because it doesn't have all of the cash in there. But you have the option to not pay that back or pay it back over time, and keep your account growing the way that you want to. So it just depends on your situation. The other really cool thing about this is, like, I'll get a little bit more into my son's plan. So he's 22, and I actually started his plan for him. As a single mom, I was not in a position when he was growing up to be able to put into, a college savings plan or something like that for him. And so now that I am funding his policy $250 a month. So I'm overfunding it to allow it to grow cash. Next year, I will be max funding it. So I will be pushing that amount I put into his account up to the max amount I can within the framework of that policy that I built for him. And I'm going to do that until he's 30 years old. Now I started it last year when he was 21. So over a 9-year period of time, I will put more money in there than I would have been able to save in small increments earlier. And because of how this policy works, it's just going to grow exponentially from there. At 30 years old, I'm going to turn the policy over to him. So I'm going to transfer ownership to him and allow him to continue funding it. Now he can bring it down to the base amount he can pay. He can bring it back down to paying $250 a month into it, whatever the case may be. But this is a policy. My son is in the military and he plans on staying in for 20 years. So when he gets out, he'll be 38 years old. He'll have a retirement from the military. And on top of that, he'll have this account sitting there that he has access to the money in. So say he wants to start a business. He can utilize his own funds from this account to fund his business and not have to go into debt. He could use the funds from this to put a down payment on the house and a house and plant some roots somewhere. He could use this if for some reason he wanted to, he's got GI bills and things like that to help pay for school, but any added expenses regarding school beyond what's already covered, or if he's married with kids, he can utilize it to pay for his kids' college education. So tons of flexibility overall in the product, but the availability of that cash to you along the way and tax-free is the most phenomenal thing. So you're growing your money tax-free, you have access to it tax-free, and in retirement, when you start drawing from it, you're drawing from it tax-free as well. So it's called tax advantaged. It's a tax advantage product. These are after-tax contributions, tax-free accumulation, tax-free distribution, no premature distribution penalties, no minimum required distribution on the back end, like a lot of products at age 72. If you're not drawing enough from them, you're going to get, you can get taxed additionally on that. And then in addition to that, it's creditor protected. So if you are ever sued for any reason, nobody can come after this money. Nobody can take it from you. The IRS cannot come after this money. So there is a huge component of protection on multiple levels within this product. But again, it's called an index universal life insurance policy. We like to call it the financial pocket knife. And from walking through all those components, you can see better now why we call it the pocket knife, because it offers protection and savings. But within that, again, as a recap, you get permanent life insurance, you get living benefits, you earn interest, you have liquidity, it's tax advantaged, and there's creditor protection. So and then each of those has detailed components as well. So those are the components of the pocket knife, as we call it, that you are able to utilize along the way as you need. So again, that's a great product I use with a lot of my clients in their 20s and 30s specifically. You can start with a small amount and build from there. And the tax-free aspect is just it's just phenomenal. So I wanted to go over that product initially. and talk a little bit about that. Again, this is a product you could use in your 40s and 50s if you do have a significant amount to put in there. Because remember, as I've talked about before, life insurance gets more expensive the older you get. And if you have any health issues, if your height to weight ratio is significantly off, something like that, it can cost more for your insurance as well. So these are great plans to start. When you're young and healthy, you can start with a small amount of money, but in your 40s or 50s, if you had $1,000 or $2,000 a month and you're like, I want to put it somewhere, I want to grow it tax-free, there's a possibility you could utilize a plan like this and still accumulate some significant wealth. I also use these plans with my clients who have younger children or even grandchildren. So you can get a policy on them and utilize this plan to be their college savings plan. You can get it on them when they're really young. We call it $1 million baby plan. And so, the younger you are, the less expensive the true costs of this plan are from the life insurance perspective. And so you could put even significantly less in and still, over time, generate a significant savings account to pay for, like I said, college, a wedding, or, if they don't go to college, if they don't get married till later, it's something you could transfer to them to take over and continue funding for their own long-term financial future. So a really incredible product you can use for a lot of different things. Now, the next product I want to talk about, again, is one that this is probably in the last 12 to 18 months, the product that I am using the most with my clients that fall in my target market. So again, 10 to 15 years out from retirement, currently in retirement, or caring for somebody in retirement. It is fixed index annuities. And I know, historically there's a lot of opinions out there about annuities, but I believe I've said before on my shows, just like cars advance over time, homes are built differently than they used to be. Computers, technology is constantly changing. So is the financial industry. And so I encourage you, if there's anything you may have heard from your parents or the older generation about financial products that they raise concerns about or something, is that you look at them again, because they really do change over time and advance and offer things they didn't used to. Annuities back in, the 80s, didn't offer a lot of the things that they do today. They didn't offer some of the protections, and they didn't offer the death benefit to your beneficiaries, a lot of them that they do today. So what are fixed index annuities? These are insurance products that combine guaranteed protection from losses. So again, you're protected from losses in the market downturns with the opportunity to earn interest based on market indexes again. So they also help address volatility risk, longevity risk, which are two big concerns about clients who are getting closer to retirement. And they offer higher potential returns than their fixed rate alternatives. So a really good product, when you're looking at, where am I? I'm 45, 50, 55 years old. I'm going to retire at 60, 65 years old. And I do have some things I've been saving. I've got a 401k. Maybe I have an old 401k. I've got some savings I've built up in my bank account, or something like that, right? Hey, Natalie, let's sit down and look. Where am I? Where am I? Am I on track? Of course, as you guys know, I always do a financial needs analysis with my clients and identify their financial independence number, or FIN number, based on their goals, based on the way they want to live in retirement. How much do they need to have sitting there when they go into retirement that will either cover those costs or is enough for them to retire, and that money will continue to grow so that over time it covers the lifestyle they want to live. It gives them that time freedom, that financial freedom that they want in retirement. Okay. So, This is just a huge product I've been working with in the last year, and I'm really excited. I just recently did an annual review with one of my clients. So let me tell you, like I said, this is a lump sum in most cases. There are a couple fixed index annuities that you can open with a smaller lump sum, and you can add to on an ongoing basis. But for the most part, fixed index annuities, you have a lump sum of money. You want to put it somewhere. You want to set it and forget it. Set the money in an account, forget it, and let that account do its thing and grow your money for you. So a lot of times the clients that I'm working with on these, we're moving like an old 401k. So they left a job 5-10 years ago, left the 401k. And I know for me, I've talked before about, I went through a window in time in my career where, I switched jobs for reasons that were outside of my control, but at each of those companies, I had an old 401k, right? So they've left that old 401k sitting there. Let me first say, when that happens, nobody's watching it for you anymore. Nobody's making moves to try and protect you in the market in your 401k. So if you have a 401k, please reach out to me. You don't have to reach out to me. Reach out to me if you don't have a financial professional. But if you do, reach out to them and figure out where you can move that old 401k to, one, put some protection in place, continue to grow it, and actually have it be a significantly contributing factor in your future financial plan. So, who benefits from fixed index annuities? People with moderate risk tolerance who want to protect their downside in volatile markets. Sorry if you can hear my dogs in the background. They're playing outside my office door. Anyway, so people with moderate risk tolerance who want to protect their downside. So they want protection from the market, right? The closer you get to retirement, the less risk you want to take, because you don't want to end up having the market drop a year or two before you're going to retire and you lose 30% of your money. Now, maybe you have enough in there still to retire, but, you got to like wait that out to grow back, right? If you were to just pull all of that money out because of a loss, you would have a permanent loss. And sometimes if you lose that amount, you've got to continue working at least part-time into retirement, to make sure financially you're where you want to be. So, definitely this is for people who are willing to lock up a portion of their retirement savings for 5 to 10 years in exchange for higher potential returns. Individuals seeking to secure a portion of their future retirement income through regular income payouts at the annuity's maturity date, or with a guaranteed lifetime income rider, which is phenomenal in these products. People who've maxed out a 401k or IRA. So I do have a client right now I'm working with. He was so significantly overfunding his 401k at work that his company pulled him aside and said, look, we've been contacted by the IRS saying you can no longer contribute at this level. It's going to create a huge tax issue for you down the road if you do. So we're now going to push this money back into your paycheck. And you got to find somewhere else to put it. And individuals who want to leave a legacy. So fixed index annuities, like I mentioned earlier, do include a death benefit. So, you have a chunk of money. You don't need it in retirement. You've got enough other things set up, or potentially if you don't utilize all of this, by the time you pass, there could be some left over. You want to leave that as a legacy to your family. So what are the benefits? Guarantees. You can choose fixed rate of interest products, or your annuity will always have a minimum guaranteed contract value. So you have a minimum amount guaranteed to get in these products, but you can exceed that. Or, if you want to just kind of know what this is going to do, you can pick a fixed rate of interest. So I've talked before about how I put my parents in different products. They were both fixed index annuities. One of them has a fixed rate of interest. So as long as we don't tap into that money at all during the lifetime of the annuity, it's guaranteed at least to earn this amount. It's a fixed rate. It could exceed that based on the performance of those indexes. So That's a product we feel like we don't need to touch. It's a smaller amount of money. Anyway, so that's growing. The other side of that, we put a larger lump sum in a fixed index annuity that's built for max accumulation. So earning as much money as possible as quickly as possible. Which gets me to the next benefit, growth potential. You can pursue additional growth with interest credits based on external market indexes. Some of these products offer premium bonuses. So when you transfer your money into them, there's a premium bonus that you can get, and those are applied in different ways depending on the product. They offer protection. So again, no downside risk in the to your money from the market. They are tax deferred. So as you start drawing from them later, you will pay taxes on the amount you draw out. So similar to a 401k. Income. You have the option to create a regular stream of income for either a set number of years once you turn on income, or for the rest of your life. And I literally mean for the rest of your life. Even in some of these products, if your account balance goes to zero and you have a lifetime income rider, you are going to continue earning that income for the rest of your life, even though you technically have no more money in the product. And they offer the death benefit that we've talked about. So some of the riders, bells and whistles, I like to call them, that you can add on to these kind of products: guaranteed lifetime income, I already talked about. A rider that offsets for cost of living and inflation. So you get adjustments along the way to combat those two components. Long-term care. So in these products, you can, if you medically qualify, you can add long-term care. So it can provide for you in your later years. And those are structured, long-term cares within these are structured differently by the different providers and the different products, because some are designed to grow money. Some are designed to distribute money, a lifetime income. Some are designed to do both and some more. So definitely talking to your financial professional to let them know what's most important to you to build this product the way that it fits you. Disability riders. So if you were to become disabled, terminal illness riders, if you were, diagnosed with a terminal illness, and again, the death benefit, which I love to talk about, because that's one of the things back in the day, these products didn't offer a death benefit. And it's why a lot of people today, in the older generation, when you mention an annuity, they're like, oh, no, I'm never doing an annuity. And so that's why I educate on this, to make sure you realize how much things have changed and how much is available to you. So as you can see from the benefits and the riders that come along with these, you can get a lot of the same protections and benefits in these products that you can get in the Index Universal Life product I talked about first. This is not a tax-free product, though. But a great addition to a financial plan to diversify things as you get closer to retirement. Like I said, I work with a lot of people to move for old 401ks. And I think I started to mention earlier, and I'm not sure that I finished it all, was I'm working with a client who reached out to me. Actually, his wife reached out to me a little over a year ago. And she said, I really need you to talk to my husband. He's been waking up in the middle of the night so concerned over some old 401ks he has and how much money they're losing. So this client had lost, I think it was around $60-ish thousand in the first quarter of 2022. Now he had, I think it was 5 or 6 old, he was in sales. So he moved around companies in that industry. He worked in sales, and they really have their retirement set up through other products and savings and things they've done. But this was a significant amount of money in these old 401ks. And so once they started losing, he cared a little bit more about where they were. And it was literally waking him up at night. And so she connected me with her husband, and I was able to combine all of those 5 or 6 annuities, or 5 or 6 old 401ks, into one large annuity focused on accumulation and growth. This is 100% a product that he anticipates being a legacy product that he leaves to his kids. So he just wants to protect it and accumulate. They don't need it for their own personal retirement. So we put him in a product built to do exactly that, accumulate, for 7 years. At the end of that, we'll make a determination of, are your goals still the same? Do we want to, push this back in for additional maxed accumulation? Do you want to put this somewhere that you could turn on income from it? Like whatever. So have things changed? Do we need to modify the approach with this lump sum of money? And also, because the industry is constantly growing, products are improving all the time. In 7 years, there may be a whole new set of annuities, or depending on what's going on in the market, it may make some sense to shift that somewhere else. So gives us the ability to reevaluate that. He is about 15 years from retirement. He plans on retiring at 65. So he's around 50 years old. And so definitely some great time to accumulate as much as possible before he retires, and then do whatever we need to do from there with this product. But 2 weeks ago, I met with him for his annual review. So first year returns. The really cool thing is there are some different things you can do. There are indexes that you pay a very small fee for, but they can really almost, I call it turbocharge your earnings, with what's called participation rates that can bump up what you're earning in those accounts. And so he was, he earned money, the straight interest rate. When we were talking, he's like, well, I earned money. And so I'm excited about that, But then when I reminded him that he had that participation rate multiplier, he actually earned more than he thought. Just in year one, he had earned back 25% of what he lost in the first quarter of last year before I talked to him. And you can also put your money in indexes that are 1 year or 2 years. So for different kinds of strategies. And so we put some diversity within his indexes, and he is on track next year to fully earn out of that first quarter loss last year and then some. And that for me is why I do what I do. For the opportunity I have to sit down with my clients each year and see that, or have them be able to see that the protection I told them they had is real, that the earnings potential I told them they had is real, that, the growth, the advancements of their products, whatever it is they're in that we're looking to gain, they can see those real things happen each year as you move forward. It builds their confidence, not only in me, of course, but in the products that they're utilizing, and in themselves. It builds confidence that they made good educated decisions. They're building towards their retirement, their life savings, their kids' college funds, whatever they may have in place. It just gives them the confidence that they have something in place, which I think in turn provides peace of mind. I'm doing the right thing. I'm protecting my family and protecting my wealth. And for those clients who are in the position, they're setting up to leave a legacy to their families that can change everything. And so, like I said, I really wanted to hop on here and just talk about the products I use to, one, set the foundation with my younger clients on building towards a retirement. And because they're young, they can do that with a small amount of money. My son's other IUL that he started himself at 18 years old when he got out of boot camp, he funds about $130 a month. And I believe when he retires at 38, it's projected to have somewhere between $300,000 and $500,000 in it. He could pay cash for a house with that, you guys. No taxes, no penalties. He could use that to start his dream business. It's a game changer. He could also leave it there, and at retirement, it's projected to be over $1 million, well over $1 million. Of course, we don't control. That's not a set guaranteed earnings. We don't control that. So, but both of these products, when you earn and they apply that earning, it is locked in. You can never lose those locked in earnings that they apply along the way. So even if you have a 0 year or a 0.75 year or a 1% year, um, you're never losing what you put in, those locked in growths you've had each year or every other year, depending on how your product's set up. And that just gives you the ability. So when you do have earning years, your money's compounding quicker because it's never earning out of a negative. So these are my absolute two favorite products. There are times and places for them, and there are times and places not for them, depending on your situation. So, like I always say, I want to I want to provide information, education to you through this radio show that allows you to sit with a financial professional. Reach out to me if you need to. My contact information is always in the show notes. And have the conversations to give yourself some peace of mind and know that you're on track. It is very rarely that I sit down with a client that's got it all together and they're set and ready to go. But when you can create a foundation and then build, create financial building blocks to add on top of that foundation, you can end up in a really strong, secure place for later in life. So that's what I wanted to share with you today. A couple of my favorite products, still focusing on retirement. Of course, like I said, I have shifted a lot in that direction. I've really realized since my parents moved here last year, and I'm so embedded in caring for them, knowing what kind of insurance benefits they have, knowing what kind of this, that, and the other they have. I really, in the last couple of months, have realized that my work and my personal life have really intertwined at a whole new level. And there's such a need for people to understand what happens in your later years, what you do and don't have available, or what you should be prepared for when you get there. And so these two products can do both of those things. The annuities are something I utilize for my parents. And so I hope I gave you some value and taught you something maybe you didn't know, or just gave you a thumbs up if you have these products that you're going in the right direction. I'm your host, Natalie Kime, and I look forward to continuing to bring you amazing content each week that will stretch both your mind and your financial future, and of course, set you up best to live the way you want to live in your later years. I will see you next week. And again, you can look at the show notes, contact me. My contact information is there, but you can always contact me at natalie.kime@wealthwave.com. I wish you the best. And again, I'll see you next week.